It's time to get to the heart of the matter and get down to the bottom line on fees. Nobody likes them, but they are what they are. So let's talk fees this week on Phil's Tax Hacks and Other Retirement Facts. Welcome into Phil's Tax Hacks and Other Retirement Facts with CPA and personal financial specialist Phil Putney. Now let's get rolling with today's show. Hey gang, welcome onto the podcast with Phil Putney and myself to talk about, investing, finance, retirement, and fees. Nobody likes them, but the world goes round because of fees, right? Everybody's got to make a living. So let's talk about them, Phil, this week on the show.
All right.
What's going on, my friend? You doing all right?
Doing great.
Yeah. You ready for some vacation time?
Yeah. We've got it on the calendar. Got the camper all checked out, ready to go. So
yeah.
In fact, we're
and you had to pay
heading out in a couple of weeks. So
and you paid some fees to get that camper all prepped and ready to go.
Unfortunately, you paid some fees for it. Absolutely, got it checked out. So
that's my segue.
Yep,
that's my segue into fees. No matter what you do, there's fees. I think we kind of even pay fees on breathing. And we always used to say the only thing you can do for free is breathe, but I'm not even sure that's true anymore.
So not anymore.
Right. But let's talk about some financial fees, my friend. There's two sets of them, right? So there's really kind of two sets of fees in a financial standpoint. So what are we talking about?
Yeah. So there's really think of it like two layers of fees. I mean, there's the investment vehicle fees, right? So mutual funds, ETFs. I mean, they all have underlying fees associated with them. Sometimes the
product fee.
Sometimes referred to as an expense ratio, right? So, I mean, at the end of the day, talk about a mutual fund, right? What's going on? Well, it's a company. At the end of they're running a business. So that fee, the expense ratio they're charging covers the cost of the manager. There's somebody in there or a group of people in there managing the strategy, running, the buys and sells and what should they buy and doing all the analysis behind it. There's trading, it costs them to buy and sell, and they've got buildings and facilities that have lights on. So, I mean, nothing's free. It's built in there somewhere, right? So there are fees associated with financial products. And then that's kind of where the ETF first came about, was the whole concept of helping it be a more cost-effective vehicle. And they are, but there's pros and cons to an ETF versus the mutual fund. Depends on what you're looking for. But that's kind of the first level, is the investment vehicle. Then the other level doesn't apply to everyone, but if you're working with an advisor, then they are going to layer on what their fee is, how they get paid for their services.
Right. Which brings up the argument of
management and everything else. So.
Yeah. And that brings up the whole DIY argument. You'll hear, I'll just do it myself because I can save money. But it's like, a lot of times most advisors are only charging 1%, typically in a lot of situations. And there's a lot of studies and a lot of information out there, even from these companies that let you do it yourself, like Vanguard, for example, that say, hey, advisors actually bring value to make it worth that 1% or make it worth that fee.
Absolutely. Yeah. And that's where, I mean, to me, at least in this industry, fees have gotten too much press, too much focus. Are they important? Absolutely. I mean, it's like, it takes away from the return. So anything that does that, potentially, but at the end of the day, you need to look at kind of the net, right? After the fee, that's the only thing that really matters, is performance net of fee. So especially just in the investment vehicle standpoint, to get a real apples to apples comparison, the thing that would matter is if it's the same type of product, so large cap growth mutual fund versus a large cap growth ETF. If they're being managed both the same way, effectively, it's a same strategy, then fees become relative, because now it's A or B, which one's cheaper? Do I buy the name brand or do I buy the store brand? I mean,
isn't that the conversation, Phil, though, between mutual funds and ETFs? Sometimes people say, well, mutual funds tend to carry more fees.
Well, yes and no. But the thing with mutual funds is mutual funds a lot of times are more, can be at least more actively managed. Right. So, I mean, you can have an indexed mutual fund. So, I mean, it's just trying to mirror an index, right? So there's not a lot of active management in there. So fees on them are going to be very low. Same thing with an ETF. And there are some actively managed ETFs, not as many. They're starting to become more because that vehicle is still relatively new, but a lot of them are more index type driven, meaning that they're designed to do something specific as far as an index or, a certain segment of the index, so whether it's a large cap growth or value or whatever, technology or, what segment of the market are you trying to gain exposure to? And that would be more of an apples to apples comparison, versus like a mutual fund. It might be that, but then the manager's laying on some value because they're doing some significant analysis to come up with, well, these are the 50 companies that I think fit into that best, or whatever it happens to be. So you have to look at really, at the end of the day, the difference between the two, right? And what you're trying to accomplish.
Yeah, so the most important factor you're saying is when looking at fees inside the vehicle fee is
Right.
that performance net of the fee, right? That's what you were saying a minute ago. So then if you take that into account, then what? Do you go to the comparative fees between investment advisors?
Well, and then that gets into a whole nother scenario too, because now, yeah, the investment advisor, they have their fee, but what value are they bringing? And at the end of the day, if you want to really get a true picture of fees, you need to understand what is the combined fee, right? What is the underlying investments plus what am I paying the advisor to get to what the true fee is? And then what's if you are working with an advisor, well, what is the value they're bringing to the table for
Sure,
their,
like anything.
their fee, like anything.
Yeah, what's the value
Right.
add to this service? And that's where, again, we talk about it often. It's like you could DIY and try to self-manage your portfolio, but there's a lot of studies that show that advisors are going to help in that regard. A lot of times it's even just behavioral management because we tend to move around so
Absolutely.
much when we're doing it ourselves that you're saving us fees if you're having that conversation because we're not
Right.
constantly moving things, which costs.
Yeah, I mean, and there's a lot of value advisors can bring. I mean, that's one of them, just the whole behavioral side of it. Arguably having a plan, right? What is my overall financial strategy so that investments shouldn't be the focus, right? At the end of the day, I think most people approach this completely the wrong way because they're looking at investments as the focus and then living their retirement based on the investments, which obviously investments play a big role in that retirement.
Well, if you're
But you
30,
need
you're
to-
looking at the investments way different than you're looking at retirement.
It's a totally different process, right? Exactly. Now investments are more of the focus because you're trying to grow, right? A totally
Right.
different scenario. When you get to retirement, things change dramatically where investments are key. They're important. I mean, that is what's going to fund your retirement. But what does that retirement look like? How much do I need? Where am I going to pull the money from? What do I do with Social Security? Do I have a pension? I got money in the different types of, taxable accounts, taxable, tax deferred, tax free, which money's coming out first? What does my tax scenario look like? So, I mean, there's all these different factors that play into it. And that's where it's very difficult just to add up the fee and say, well, this advisor is less expensive, so I'm going to move to that advisor.
Right. Because they
Because-
may not be talking to you about taxation. They may not be
Right.
talking to you, especially depending on what their kind of style is. They may not be talking to you at all about Social Security maximization or, even legacy because that's not on your radar because maybe they
Well, they're
only
not-
work with
they're
younger
not-
people or
Right. They're not even doing planning. I mean, they're simply an investment manager where they're looking at risk tolerance and either they or the company that they work for have developed portfolios based on risk and they're moving between different strategy, managers within that to kind of build the portfolio, but it's really investment focused versus how we approach it is it's planning first. What are we trying to accomplish? Let's get the blueprint done first. Now, yes, the investments are going to be what kind of fuels that plan, understanding risk tolerance, but we have to have the plan first. So at the end of the day, if you're looking at, well, the account over here did X percent versus you did this percent. Well, that's going to change year to year based on risk. And, is that what you're comfortable with? Does it fit into the plan? I mean, there's all sorts of factors.
Yeah, I mean,
that play into that.
and we get those questions often, Phil. Somebody says, "Hey, the S&P did, I'll just throw out
Right.
random numbers. The S&P did 25% last year, but my advisor only got me 17, so I'm going to move on." And it's
Right.
like, well, wait a minute. Well, what was your risk tolerance? What was your allocation set up? You're not, unless you were taking the entire risk to get that total amount of the S&P.
Right.
Then yeah, but what would have happened if it had gone the other way? You would have lost, the max amount, and then you'd be pissed about that. So you got to take that into a grain of salt, right?
Yes, I mean the risk is a big piece of that. Yeah, because your point, are you comfortable? And I will have clients that'll ask that occasionally. Well, yeah, the S&P did this. What's the difference? And it's okay. Well, let's look at risk tolerance again. This is the S&P. Are you comfortable risking losing over half of the portfolio at some time? What would you do if that happened? Well, no, that's okay. Well, but that comes with it. You can't look at just everyone wants the big number returns, but no one wants the risk. And unfortunately that just doesn't exist. But again, that's where it comes back to having an overall plan, so it's funny. I've got a client that I've worked with, her and her husband for years. He recently passed away. And she was talking to some of her friends and her advisor, a big box, brokerage type advisory firm, took a look at her portfolio that we're managing and, basically come back and said, well, we can give you, our friends and family discount from an advisory fee standpoint, and it was about 40% less than what our advisory fee was. So, and that's kind of what led to this. And I'm like, okay, well, let's run through the facts of this scenario. And so the number one thing that we came to is, what are they using for their investments versus what are we using? Let's get to the investment fees. Well, our portfolios are designed with ETFs and individual securities. So they were relatively low fees. They used only mutual funds. Okay, well, now that we layer on the fund fee in addition to their fee, compared to our fee in addition to the underlying ETF and stocks don't have a fee, well, now rather than this big difference, it was relatively small. It was less than 10% difference.
Okay. Okay. So it went from 40 to 10.
Now we're getting into the ballpark. Okay, well, it's close. It's not as big of a number as they'd like you to believe. Well, what are they going to do? Here's the things that we do. And just walk her through, reminding her, this is we've set up the plan. We're doing Roth conversions. I mean, we had been planning with him for years, had planned for in the event either spouse passes. We didn't know, but he, ended up passing early. Well, that was part of our original plan. We had life insurance for that because we knew that if that were to happen, there was a risk to her. So at the end of the day, she's going to stay with us just because fee isn't the only factor, versus the original discussion in having with her friends was, well, my advisor is only charging me X, and what's your advisor paying? Oh, it's that. Oh, you ought to move to my advisor because they're cheaper. And when she first, told me this, I mean, I emailed back and said, hey, I'd love to be able to, do an accurate comparison. If you can send me what they're recommending, let's start that discussion and I can walk through, first of all, the true fee discussion, and I put in there, and it's true. I said, look, cheaper isn't always better. Right?
Well, kudos to her for going through that process instead of just going with the sales, the quick sales pitch, right?
Yeah. But I mean, that to me is the reality at the end of the day. Don't get focused on fees. It's one of many factors. Is it important? Absolutely. Because it reduces the performance potentially. But if the advisor is doing their job, the net performance, and this is where it gets a little hard to challenge, or quantify, because it's not always the numbers on the paper, especially if you're doing tax planning and everything else, because if we're doing Roth conversions and planning, our numbers on a statement are going to be lower than what the other advisor's numbers are because we already paid the taxes, but they haven't. I mean, so that it becomes a real hard apples to apples comparison, but you can do it. It takes some time to figure it out, but it's not an easy process.
Yeah. So, that's a great point though. That's a great story.
Like a lot of these mutual fund companies, I mean, that's nothing against them. They've got their target and why they do what they do, but they're low cost. They're a low cost provider.
I mean, the Schwab commercials right now are always like, they're funny, right? Because it's like the guy gets mad, he goes Schwab, because they're cheaper. But again, is the value add there for the right person?
What are you getting for that fee? What are they doing? It's like buying a car, right? If your primary focus is the most efficient vehicle, then I get it. And you're probably going to end up with a hybrid, or an electric vehicle for that matter. But that's one piece of the factor of the overall equation. We tow a camper, right? I'm sorry, I can't tow a camper with a hybrid, right? Or an electric vehicle. I need some power behind it.
A big camper, yeah.
My mileage is different than somebody else, but that wasn't what I was looking for. It's one factor that went into the big equation. So.
Well, I was thinking about this as you were going through that piece, and you went to the car bit. But I had a food analogy that I was going to throw in, and we'll kind of wrap up fees with this. It's again, what are you getting for it? So I recently hadn't been to a Chili's in a really long time, and went to a Chili's, and they had several things on there about their burgers, and it said with the price of burgers now at McDonald's, wouldn't you rather get a much bigger, freshly made, whatever their little sales pitch was, burger at Applebee's? Now, in my mind, I'm like, yeah, I know it's all still frozen stuff, and it's still kind of a chain, Chili's is a chain. Sorry, I think I said Applebee's, right. Chili's. It's still kind of a chain thing, but it made a good point to go,
right.
Is the burger that I could get at Chili's better than the one that I would get at McDonald's for roughly the same exact cost now because they've gotten there? And I thought, well, yeah, I think I'd rather like the extra pieces that come with Chili's, which is the coming in and sitting down and having someone bring it to me. And all those little extra pieces. Now, do I have to tip the server? Is that going to add to my bill versus the McDonald's? Absolutely. But I think that the value I'm going to receive now for that Chili's burger versus that McDonald's burger, I'm okay with the couple extra bucks that gets tacked on at the end by going to Chili's, because I can now sit and talk with you, Phil, or whomever my guest is, in a more pleasant experience. And again, you can hit us with comments down on the thing about Chili's sucking or not sucking. That's not the point. It's just literally the point of...
It's just an analogy here. Right?
It's just an analogy, right? So hopefully, but you kind of see where you were going with that, with the same thing with fees.
Right.
What are the other little intangibles that might make that a better feel or fit for what you need?
Right.
Hopefully that makes sense.
So absolutely. Fees are a piece of it. It's something to consider. Understand it for sure. Don't ignore it. But you use it as one piece of the equation. Look at the whole picture overall before you make a judgment on, well, this is lower than this.
There you go. So I tell you what, folks, we're going to wrap it up this week. Don't forget to subscribe to us on Apple, Google, Spotify, and feel free to put something in the comments. If you're pro Chili's or you're pro McDonald's or you're boo to both of them, knock yourself out in the comments down below. But the same thing when it comes to fees, right? There's big box, there's a small box. What is it that you're looking for? What is it that you need from the experience and from the advisor or from the brokerage firm? Are you a number in a big cog machine, or are you getting hands-on experience or getting hands-on treatment? All those things factor in. So if you got some questions, need some help, you know what to do. Call Phil, 248-888-7530. Numbers on the screen, 248-888-7530, or visit him at philstaxhacks.com and get yourself onto the calendar. Check out lots of good tools, tips, and resources there. Of course, it redirects back over to his main website at philstaxhacks.com, and check the show descriptions for all that information. It'll be in there for you to click it on there. And we will see you next time here on Phil's Tax Hacks and Other Retirement Facts. Phil, my friend, have a great day, and I'll talk to you soon.
Investment advisory services offered through AFS Wealth Management. The content of this program is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. Investments and/or investment strategies involve risk, including the possible loss of principal. There is no assurance that any investment strategy will achieve its objectives.